The markets are telling you that they're expecting 20% earnings growth per year for the next 5 years, about triple what the historical norm is. There's been an inflection point in the technology curve with generative AI. We know that it's a big game changer, but are we going to deliver that sort of earnings growth? I'm a little skeptical about that.
What changed Dave Rosenberg's bearish outlook is on Consuelo Mack Wealth Track.
Funding provided by ClearBridge Investments, the Fairholme Foundation, First Eagle Investments, Bill Miller, Baird, Strategas Asset Management, Research Affiliates, Royce Investment Partners, Seafarer Capital Partners, and Women Investing in Security and Education.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. Every year on Wealth Track, we do an in-depth interview with influential, outspoken, and independent-minded economist David Rosenberg. He has long been one of our most popular guests. Rosenberg unexpectedly gave us a headline in December when he published his Memo from the Chief Economist, Lament of a Bear report, in which he said one can reasonably debate whether the stock market has risen exponentially, but there is no arguing that the surge in the S&P 500 these past 2 years has been nothing short of extraordinary. And it has clearly gone much further than I thought it would, especially in these past 12 months. And so at this point, it is worth the time and effort to discuss and interpret the message from the market. Tip the hat to the bulls who have, after all, been on the right side of the trade and provide some rationale behind this powerful surge. Well, for those of you not familiar with David Rosenberg, he is president, chief economist, and strategist at his independent economic consulting firm, Rosenberg Research, which he founded in January of 2020. A native Canadian, he made his reputation in the U.S. as the chief North American economist at Merrill Lynch for many years, where he was consistently ranked an all-star analyst by institutional investors. What is the message of the stock market? What is the rationale behind his powerful surge? I asked Rosenberg to share his analysis.
The Lament of a Bear, which is what I penned towards the end of last year, was trying to make sense of what happened with the U.S. stock market last year. Because, Consuelo, if you go back to the end of 2023, the consensus at that point for the end of 2024 was that the S&P 500 was going to close the year at 4,900. And we finished more than 1,000 points above that. So I'm not alone in not having seen that we're going to have another 25% total return year for the benchmark index. And what I tried to do was explain what is the message from the market. And I did tip my hat to the bulls. I think that what I had underestimated was really the power of this AI trade. Because even though the market finished the year broadening out some, it was still a very highly concentrated stock market. And it was the Mag 7 and technology in general that really drove the price action. And so what I had said was that the markets clearly saw, and let's date it back to late 2022 with ChatGPT, that the markets had basically noticed an inflection point in the technology curve, that was a big model change. And I said, yeah, they're probably right. This was a huge shift in the innovation curve. What happened was that investors began to price in more than just 1 year's worth of exceptional earnings, but actually a whole half decade's worth. Because what happens when you get this shift in the technology curve, and the last time it happened in this manner, by the way, was in the late 1990s during the internet mania, usually happens when you get this this inflection point. I mean, the innovation and technology curve is always in a secular uptrend, but this was a real shift in the curve. So, the story for last year is, earnings growth up 8%. The stock market goes up 3 times what earnings did. So you got this gargantuan expansion in the market multiple, but nobody really was looking much at the multiples. If you were a fundamentalist like me, looking at valuations, you didn't catch on to the locomotion. And so what we had done was go back to see over the past century, what is a normalized 5-year earnings growth profile for the S&P 500? And it's 7 to 8%. That's the normalized earnings trend over a 5-year period. And while I had ascertained that investors naturally lengthened their time horizons because of this inflection point in the technology curve, when we even go to the longer term view, guess what's priced in on a 5-year forward basis in terms of what the market is telling you what earnings growth is going to be doing on an average annual basis to make the valuations really make sense. And the markets are telling you that they're expecting 20% earnings growth per year for the next 5 years, about triple what the historical norm is. So I'll tip my hat and say, sure, there's been an inflection point in the technology curve with generative AI. We know that it's a big game changer. But are we going to deliver that sort of earnings growth to triple the norm over a 5-year time span? I'm a little skeptical about that. And remember, the last time that we had this sort of growth priced in was during the internet mania. And we'll see how this all plays out. But I didn't shift my view. I didn't shift my investment recommendations. And people say, okay, what are you going to do about it next? And to which I say, well, just because I missed this fast-moving train doesn't mean I'm going to hop on. Because at this particular point in time, in my opinion, there's just too much priced in, even if you're a long-term investor. Our work suggests that as powerful as AI is going to be, and it's going to be powerful and it's going to change our lives on a personal level and a professional level, but the markets aren't the economy. The markets are driven by animal spirits. The economy and productivity is not driven by animal spirits. The markets are much more volatile than the economy is. In a bad year for the economy, GDP is down 2%. In a bad year for the stock market, it's down 30%.
Right.
So the answer to the question, to the lament of a bear, well, what are you doing about it? The answer is nothing. There'll be another train to catch at another time, but this one has left the station.
So is this a mania? Are you rethinking the bubble thesis? So where are you in your assessment of where the stock market is? And then let's talk about strategy. When you're saying that I'm not going to do anything different, what is it that you're doing?
I don't think we're in 95, 96, or 97. And everybody thinks that they'll be able to time, when to get out of the market, because the one thing we know, to quote Herb Stein, is that anything that can't last forever won't. So is it a bubble? I think it is a price bubble. Back when I was called a Luddite in the late 1990s because I didn't get technology, no, the internet was not in a bubble. The stock market was in a bubble. And, everybody tells me today, well, it's so much different because these companies that are involved in AI, they're real businesses with real business models and real profits and real cash flows. I get it. But what happened in the second half of the 1990s, which started off as a bull market, morphed into a mania and then a bubble, it wasn't about pets.com. It was not a .com bubble. It was not a .com bubble. It was a broad technology bubble. And you had real companies with real earnings and real business models and real cash flows back then. And these companies, some of them, a lot of them are around today. Cisco, IBM, Microsoft, Dell, Intel. They all went into price bubbles on their stock. Their businesses were not in a bubble. Investors don't drive their business. Investors drive their share price because of the two words coined by John Maynard Keynes called animal spirits. Between 2000 and 2003, these companies, their stocks went down between 60 and 80%. They weren't .coms. They were tech companies. And it just so happens that the bubbles usually happen in technology because technology is the sexiest part of the market. And that's what drives the imagination. And it also drives the wild exuberance you tend to see in terms of investor behavior. And it's the one thing that hasn't changed over thousands of years in this business, which is the extreme sentiment between fear and greed. The economy is not driven between fear and greed, which is why the economy is not a volatile asset class, but equities are driven by fear and greed.
What are you doing? You said that you're not doing anything different. So what are you doing as far as your investment strategy?
I'm following in the footsteps of Warren Buffett. You know, Warren Buffett, who was also called a Luddite who didn't get it in the late 1990s. Why is Warren Buffett 30% cash for the first time? Why is that? So I'm following in Warren Buffett's footsteps. So I am cautious, big cash hoard. I think that you want to buy the market that's already corrected. Good grief. If the stock market had done what the treasury market's done in the past few months, you would have everybody on CNBC and Fox Business and Bloomberg pounding their fists on the tables. You got to buy this market. Do you say the bond market's had a heart attack? If the stock market had a heart attack like that, you would be seeing everybody saying, you got to buy this dip. Not just a dip. It's been a plunge. The bond market's had a heart attack. And so I like Treasury. I like these Treasury yields getting up towards 5%. I like Treasuries. I like cash at 4.5%. Unlike 2022, when, where were you going to hide in 2022 when we had that huge drawdown? People forget that the markets do go down. Markets went down in 2022, but everybody's brain has turned fuzzy because we had back-to-back years of 25%. But this time around, when the bad stuff hits the fan, at least you have a 4.5% Treasury bill that you could go into. I like Ginnie Mae bonds with the quasi-government guarantee. When you have a situation where the equity risk premium is zero, think about that. The equity risk premium is zero. So not only is the market telling you 20% EPS growth per year for the next half decade, when the ERP is zero, like it was in the late 1990s, when everybody's head was in the clouds, the market's telling you that equities have become a riskless asset. You're asking me, what is the market telling you? Equity investors who are putting money in the equity market are telling you that they are comfortable in treating the equity market as a riskless asset. It's as if the collection of stocks in the S&P 500 are trading as if they are zero beta, no risk. It's the same thing in the corporate bond market. You get the same yield in a implicit government guarantee Ginnie Mae bond as you do in investment grade bond right now in the corporate market. The corporate market, though, has in average times a 2% default rate. Well, there is no default rate in Ginnie Mae bonds. So there's tranches of what I call safe yield in fixed income that I like. On top of that, there's a whole bunch of other very idiosyncratic areas that I would point to that you want to own for the long term. I do think that energy is something that you want to own. I like the commodity space for the scarcity value. Uranium, the same sort of thing. I don't have zero in the stock market. What do I like in the stock market? I like the areas of the market that are low cyclicality, low beta to the market, that have dividend growth and dividend yield characteristics. Could you include the financials in there? Absolutely. Can you include utilities, telecom services? Absolutely. So I don't want people to think that I'm advocating a portfolio that's replete with baked beans, canned tuna, sawed-off shotguns, and barbed wire. But I am saying I want to play it safe.
Right.
I just want to report to American investors, and it was titled, Leave New York, Come to Toronto. Because, Donald Trump actually wants to make Canada the 51st state. But, there's always that joke that Canada is the 51st state. Canada is so highly correlated in so many respects with the United States. But Canada has a 15 multiple on its stock market, not 22, looking at the 1 year forward. The multiple discount between Canada and the United States has never been as wide as it is before. When the equity risk premium is zero, the market's telling you that we're not going to apply any risk premium to the stock market relative to the risk-free rate. In Canada, that ERP is 3%. Ergo, you get paid to take on the risk in the Canadian market. You're picking it up at a super cheap currency with the Canadian dollar trading at like 69 cents. So I never will say that there's such a thing as a no-brainer or such a thing as a sure thing. But good grief, if I'm an equity investor and I have a world view and I can understand why you don't want to go into emerging markets, a lot of volatility, those markets are cheap, maybe cheap for a good reason. Europe is very cheap, but also political instability there, fiscal instability, very weak economy. So the multiple is cheap in Europe, maybe for a good reason. Canada, by the way, is going to be going through a major political change, maybe in the next couple of months, with the Conservative government, in all likelihood, like 99.9%, that the Liberals are going to be replaced by the Conservatives, and the Conservatives are pro-market and pro-business. With a 15 multiple, this isn't priced in with a cheap currency. Much better dividend growth, dividend yield characteristics. Canada for an American investor. I mean, if you're an equity investor and you've had all these great winnings in the U.S. market and you're looking to deploy the winnings somewhere else, which you probably should, there's such a thing called rotation. You got to look carefully at the Canadian market.
Is that your one investment? What would your one investment be for a long-term diversified portfolio?
I like the 5 to 10 year part of the U.S. Treasury curve, notwithstanding all the Trump uncertainty. Everybody's got inflation on the brain. And tariffs will create conditions for a shift in relative prices, but we saw Donald Trump raise tariffs in Trump 1.0, and there was no lasting effect on inflation. Inflation finished Donald Trump's first term lower than it was when he started. So I don't share all this inflation hyperventilation going on right now. And I think the economy in the United States is going to weaken more than people think. I can understand that the recession hasn't happened yet, and maybe it hasn't happened, but my leading indicators are telling me that the economy is going to slow sufficiently to cause the unemployment rate to go up sufficiently, and that underlying inflation will go down sufficiently that the Fed will be cutting interest rates more than what's priced in right now. Do you remember when the market was pricing in a lot of Fed rate cuts just last September? The 10-year note yield got down for a millisecond to 3.65%. Well, guess what? I think we're going to go back there. I'm not talking about yields going back to where they were 10 or 20 years ago, just back to where they were last September. Now, maybe the bond market got ahead of itself back then, but if we go from today's level, the 10-year notes, down to 365, it's going to be a double-digit return in the Treasury market without anybody having to take on equity market risk, but you'll get equity-like returns in treasuries. But of course, treasuries are the most maligned, detested, under-owned asset class right now. And I'm a contrarian thinker. I'm just not just contrarian. I think that there will be fundamental factors. I think the inflation fears will unwind in the next 12 months. So I do like the treasury market. And look, there are some stock markets around the world that I do like. I've been long-term bullish on Japan for a variety of reasons. That's a buy and hold. And I think that if you want to dip toes into China, which I wouldn't do, by the way, but the better way to play that is in Hong Kong. And Hong Kong trades with a single-digit multiple through most of my life. The Hang Seng was the poster child for the emerging markets as a liquid index. I see nothing wrong with that. But I think that you want to narrow in your investment themes for this year. I think that we're in a period of heightened uncertainty. I think Donald Trump has injected a lot of uncertainty. And in a period of uncertainty, what tends to happen is that risk premia tends to widen out. And that's why, no matter what you do in your investments, I'm not saying to zero risks. I'm not telling anybody to de-risk completely. I would be de-risking. And to de-risk, to move after everything that's happened the past couple of years. And this is where greed comes in, because I'll tell you what happens at the peak of every cycle is people fall in love with their portfolio. It's incredible. To which I say, fall in love with your partner. Do not fall in love with your portfolio. It won't always love you back. And so the fact you're getting paid 4.5% to be in risk-free treasury bills, well, guess what? I think if Warren Buffett figured that out, the rest of us should probably pay a little bit of respect to that. So I'd say that a big chunk of your portfolio, and maybe it should be 30%, should be in cash right now. I 100% agree with that.
And Dave, as far as a contrarian call, I mean, the Fed has been signaling, in fact, that it's not going to cut interest rates anywhere close to what the market had been expecting. So you're saying that you expect inflation is not going to be a problem. It actually could come down, or at least slow, and that the Fed is going to cut more than they have been signaling? Is that what you're saying?
Well, as far as the Fed's concerned, it depends who you talk to. You talk to Michelle Bowman, they're not going to cut rates at all. You speak to Chris Waller, he's comfortable with 3 or 4 cuts. The market shifted a lot, Consuelo. The market is no longer pricing in more than the Fed right now. The market's pricing in less than the Fed. The market right now has priced in barely more than 1 cut. That's part and parcel of this big up move in Treasury yields, is the fact that the Fed has jawboned the market out of pricing in aggressive rate cuts. But the Fed has 2 rate cuts in the dot plots right now. Market's priced right now after this monumental run up in yields. The market's almost priced out the Fed entirely. Now, after Chris Waller's comments, the market's starting to price some of it back in. But what I'm trying to say is this. I don't just stick my finger up in the air or throw darts in the wall or play pin the tail on the donkey. We actually have models at Rosenberg Research, okay? And our models are telling us that, and these are leading indicators, that the unemployment rate by this time next year will be at least 4.5%. Now, that doesn't sound really scary, and there's no reason for it to be scary. What's important from a market standpoint is that is above the Fed's projection right now for the end of next year. The unemployment rate is going to be higher than what the Fed expects based on our models. Now, don't forget, when the Fed puts in the dot plots, it's a collective median number. You don't know what everybody is saying. I might have the same forecast as Goolsbee from Chicago. I'm pretty sure that I do. And we actually have an inflation model. And the inflation, we just got a set of numbers for December. Stripping out food, which of course between cocoa, coffee, eggs, and orange juice, and these are all supply side factors, import prices were negative 0.1. The core CPI, what did that do in December? It was 0.2. And we got the core PPI, and it was 0.1. So what happened is that we had a couple of months of a blip once again in these inflation numbers, and Powell gets all nervous, just like what happened a year ago with insurance rates and health insurance and the rents. And they've receded since then. So I'm not saying it's a straight line, but the fundamental trend in inflation, now, will Donald Trump really upset the fundamental downtrend in inflation? Will he really do that? Because the last president that created the conditions for inflation got turfed out. Or his successor, Kamala Harris, got turfed out. Jimmy Carter, rest in peace, presided over an inflation breakout. Inflation doesn't work out too well for incumbent presidents. So no, I don't think that there is a political desire for inflation. I don't think there is appetite amongst the population, because inflation is a social disease. When I hear people talk about inflation, you're talking about the resumption of a sickness in the economy. That's what you're talking about. Don't talk to me about American exceptionalism if you're going to talk about inflation at the same time, because inflation brings down political structures and brings down, actually, not just economies, but brings down empires. There's not going to be any inflation. There's no tolerance for it. It's a social disease. It's a tax on the 2 most vulnerable segments of the population, the elderly and the poor. What is all this incessant talk about inflation? It doesn't mean that every month is going to be a great month for the CPI PC deflator, but I'm going to tell you the fundamental downtrend in inflation is down, and it'll go down further, and it's not a straight line.
Dave Rosenberg, let's leave it there, and we're going to continue this conversation in yet another show, at which point we're going to discuss the economy. You as the chief economist, and a very well-known one and well-respected one, I'd like to devote more time to that. So, Dave Rosenberg, thanks for joining us this week, and we'll see you again soon.
Thanks for having me on, Consuelo. Great seeing you again.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is an all-weather one for individual investors. It is keep a stash of cash in your portfolio. Cash had become a dirty word in many investment circles because it yielded close to nothing in recent years. That is no longer the case. Cash and its equivalents can now hold their own and are providing a real alternative to highly appreciated stocks. Just ask Warren Buffett and David Rosenberg. But cash has other redeeming features that make it a must-have asset as well. Cash adds ballast to a portfolio in choppy markets. While other investments rise and fall, it provides stability and protection. It adds liquidity and opportunity. Cash can be put to use in a moment's notice, especially to buy when others are selling. And it provides a psychological advantage. Fairholme Fund's Bruce Berkowitz calls cash financial Valium. It keeps him calm when others are panicking. It can do the same for the rest of us. Next week, in part 2 of our interview with David Rosenberg, we focus on the economy and his contrarian views on inflation. In this week's extra feature, Rosenberg shares 2 books that have had a significant influence on his thinking. Please follow us on Facebook, X, and our YouTube channel. Thanks for joining us. Have a superb weekend and make the week ahead a healthy, profitable, and productive one.